We are here for the main points of chapter 20 of our curriculum. And I will go directly to chapter 20. On page 6, we have on page 6, what is the financial manager's responsibilities? What is the responsibilities? Actually, he is doing planning, financial planning. He is doing investment decisions, spending money, and he is doing financing, raising the money. So he's looking to obtain mortgage loans from its sources with the lowest interest rate, and at the same time he's putting this money for investment with the highest interesting rate, and he's doing financial planning for the future as well. So those are the three jobs which he's doing. And the goal of the financial manager, he's having a goal, is to maximize the firm's value. Firm's value means like the return on investments, how far it is, through two things. Through two things. Opportunity for profits, looking for good profits, the higher profits, and the lower of losses. So he avoid the losses and at the same time look to returns. He's trying to achieve returns with the highest possible profits. Profit. Okay. Also, we'll go to um, what do you mean by risk and return? Risk and return. There's a relationship between and risk and return. The more you find a risk in a project, the more the return is required, and the more the interest rate of return or return on investment is required. Look at the people who are doing welling and for oil in the desert. They ask for a high rate of return because they are working in risky projects. Why? Because not whenever you dig to get an oil well that you will find oil well. You might find nothing in most of the cases. For that reason, it's very risky. So, as long as it's risky, you will ask for high return. You will ask for high return. And this is the nature of the business. That risk and return are always on a direct or positive relationship. The more there is risk, the higher the return. The lower the risk, the lower the return. Risk and return factors, changing patterns of market demand, interest rates, general economic conditions, market conditions, and social issues. Then we will go to slide number 10. We have for the forecasting the future. We said any managerial manager, financial manager is doing the forecasting job. So the forecasting the future, forecasting is always about the future because you try to see how the future like looks like in business. So we have short-term forecasts, and we have long-term forecasts. The short-term forecasts operating plans for 1 year period, but the long-term over 1 year means from in between 1 year and 3 years or more. Some people are planning for 10 years, 15 years, some companies. So this depends upon the strategy of the company itself. Also, we have on page on the financing for the short term, we will borrow money or will sell ownership shares or retain earnings. This is what can a company do, what a company can do in those three alternates to raise the money. To raise the money. Also, we have Yeah, the risks also always like credit risk and market risk and operational risk. These are the two main types of risk. Yeah. How about the risk management? This is very important. The risk management, how to deal with the risk, how to mitigate the risk, how to handle the risk. The first thing is the risk avoidance. To avoid the risk itself, self insurance. The insurance actually transfer the risk from one body to another body. This is the main function of the insurance is to transfer the risk from you as a risk taker into another or a third body. Risk reduction. Always you try to do the risk reduction. As example, if I did the maintenance for my car, it won't make an accident. So I reduce the risk through, as example, maintenance schedules or whatever. Risk transference, this is through the insurance, like I said before, is through the insurance. Also, I have to say here, uh, yeah, types of insurance. As long as we say that the insurance is a way to transfer the risk. So we have property insurance, like you insure your house, your car, liability insurances, health insurance, like the OHIP in Canada, and life insurance. And this also, that they will give you money in case of death. They will give your your descendants in that case. Okay. So those are the types of insurance: property, liability, health, and life. Also, we have on, yeah, on this page, we have the liability insurance also. It's a business interruption insurance, theft insurance, again, it's a theft. Again, the fidelity and security bonds, security bonds, about the title insurance, about the professional liabilities insurance. Thank you so much. Welcome, my dear students. This is 21, chapter 21, and there are some main points or aspects here I just want to talk to you about. But let's go directly to page 7. We'll go to page 7. Usually in the markets, the stocks and bonds, stocks are common. We have common stocks and preferred stocks. Common is the most which something is like common, very, very famous for all the people. Preferred is a kind of stock that's having privileges over the common stocks. How about the bonds? The bonds is like when the country is in short of money and they need to borrow. This is a country. Countries through the federal bank or the central bank, they issue bonds to the public. So the public will, by other meaning, the government will owe this amount of money to the public. Then, as example, the government borrowed $1 from me in figure of bond. The government will not return it back to me $1, but it will return it back to me more than $1. Well, that's what we call the interest rate. So if the interest rate is 10%, that means I will have $1 and 10% after 1 year, or $1 and 20% after 2 years, and so on. If it is with a simple interest, not compound interest. Okay. We said we have common stocks and preferred stocks. The common stocks ownership that allows voting rights can be bought and sold. Liquidity may pay dividends. Yeah, but preferred stocks, dividends set at issuance and are paid before common stocks dividends. So it's having a privilege that the dividends or the profits will be paid before the payments of the common stocks. For that reason, it's prepared as the super one, super stocks. And also, ownership does not allow voting rights. So if you have preferred stakes, you won't have the voting rights in this case, like the common one. But this is for whom? The owners, the ownership doesn't allow you to do this. Types of securities are mutual funds, future contracts and options. We have also here, uh, just I need to give you an idea what we have two kinds of stocks. That's over the counter market and Nasdaq. This page is very important because it includes all about the markets. So we have the markets average, we have the market indexes, we have the Dow Jones, and we have Standard and Poor's. Those are the market indicators. So as example, what's the market? The average summarizes prices behavior based on average prices of groups of securities at a given point in time. Market indexes measures the current prices behavior of securities relative to a base value set at an earlier point. Dow Jones is an indicator, measures the stock prices of 30 large well-known corporations that trade on the NYSE and Nasdaq. Last thing is the Standard and Poor 500 stocks index. This is also a standard index. Market index that includes 400 industries. Last one was large 30, 400 industries, 20 transcriptions, 40 public industries, and 40 financial stocks. Finally, we need to know what about trends in securities and securities markets. We have rebuilding investors' trust now because the changes which happen in the world make the investor, if he's even aware of some points, he must be non-aware of a lot of points. So you have to build back his trust to invest, to make him not worried, to let him not to be worried about investments. Stronger rule for the SEC securities and Sarbanes-Oxley Acts of 2002. Thank you so much for listening. Thank you. Oh, Welcome, my dear students. Welcome back, my dear students. This is the last chapter of this book or curriculum, and we will talk now about chapter 22. And I will just now we share the screen, so I will go now directly to the points which I need on page five. On page five, let's see page five or the slide of page five. Here we have the financial planning. Planning is like what you know, trying to forecast the future and know about the future, whatever you can, based on digits and numbers. And the first steps, like what you're gonna do about the planning itself. So first thing that you will have a goal, establish financial goals. Then you will gather the information. Then you will analyze this information to make sure, uh, and it must be precise information. Develop a plan. You will develop a plan and implement this plan. You will implement the plan. Then monitor your plan. Monitor, like control your plan and check out what parts are done, what parts are not done, and so on. After that, we'll go to page 11, where about the tips for the credit cards, your credit cards. Don't wait until the last minute to pay for the credit card. Talk back, ask for a lower interest rate. Always ask for a lower interest rate and removal of any fees. Check your statements always. Credit cards fraud is widespread, so everywhere there's fraud about the credit cards, so take care to protect your credit card as well. On page 15, also from the important points which we want to talk about, the taxes. What are the types of taxes in a society? We have income tax, we have social security and Medicare, we have sales tax, we have property tax. So we have types of taxes. There are four types. So if I ask you what are the four types of tax, you will tell me those four. Page 16. What factors should you consider in deciding what insurance to purchase? Which insurance you will buy life insurance, property insurance. Okay. So selecting insurance is like property and liability insurance, like the automobile or house owners and or renters. This insurance. Health insurance like indemnity plans, and managed care plans, managed care plans. Or, like as example, some people are buying the insurance for $200 a month, which will give them everything coverage, surgery, cosmetics, whatever. Disability income insurance, and we have life insurance, term life, whole life, universal life. Also, we will go to page 17. We want to read. Okay, we'll go to page 20 now. The investment goals. What are the investment goals in a society? Investment goals in a society include income and the growth and the safety. For the income, you always try to look for a low risk security. As long as the risk is low, then the return will be also low. As example, the treasuries, the corporate bonds, the preferred stocks, and the income stocks. So all those are choices for the income. If you are going to invest in those types, so this is the income. The goals is growth. If you want to grow, you will try to check for growth stocks with above average rates of growth in earning and prices. If you want the safety, you will look for the government and high grade corporate bonds. The safety in the bonds because money, the money of the government is guaranteed. If the government borrow from people, it's guaranteed that it will pay back to them in return. Preferred stocks and mutual funds. How you will develop an investment strategy? You will establish emergency fund. You will start early. diversity, always we say diversity reduce risk. So you can take some bonds with some stocks, okay, with some preferred stocks and some common stocks. So you can make a mixture because the mixture also always the diversity will reduce the risk. Invest regularly. Uh, just for the investment, it needs a regular time, not for a snapshot and go. No, it needs that you will work on a regular basis. Also, the trends now in investments increase in identity theft and upload of Gen X. This was about the short points of chapter 22. Thank you so much.